If you've ever bought a call option, watched the stock go up, and still lost money, you're not alone. Or maybe you bought a call option before earnings, the company beat expectations, the stock rose, and your option still dropped in value. In this video, we'll break down common option trading mistakes and how to avoid them. Unlike stocks and ETFs, options have an expiry date, and part of an option's price or premium comes from the time remaining until expiry. As the clock ticks closer to that date, that time value gradually disappears. Every day that passes, your option loses a little bit of its time value. This is known as time decay. By the time an option reaches expiry, time is up, and time value falls to zero. Let's say a stock is trading at $50, and a call option is priced at $5. If the stock rises on positive company news, you'd probably expect the call to rise as well. But that's not always the case. If the option is getting close to expiry, time decay may offset the impact of the stock's move. That's why investors can be right about the direction of the stock, but still lose money on the option. Time decay accelerates as an option gets closer to expiry. A metric called theta estimates how much value an option may lose each day due to time decay. You can find theta in the Option Chain quote on the Investor's Edge platform. With options, timing can matter just as much as direction. As we saw earlier, more than one factor affects an option's price. Another important one is volatility, and its related cousin, implied volatility. Volatility measures how much a stock has been moving. Implied volatility reflects how much the market expects it to move in the future. Just before a company announces earnings, implied volatility is often higher than usual because of the uncertainty surrounding the results. All else being equal, higher implied volatility leads to higher option premiums. Imagine a company has an earnings announcement coming up, and there's a lot of uncertainty around the results. You expect the stock to drop, so you buy a put option. Earnings are released and the stock does fall, just as you expected, but your put option still loses value. What happened? This is often called implied volatility crush. Once earnings are announced, the uncertainty disappears and implied volatility drops sharply. If volatility falls enough, it can offset the benefit of the stock moving in your favor. When trading options around earnings, remember that you're not just trading direction, you're also trading volatility, whether you realize it or not. Buying cheap options can feel like a low-risk trade with huge upside potential. But cheap options are often cheap for a reason. Low-priced options usually have a very small probability of finishing in the money. Cheap doesn't necessarily mean good value. It often means low probability. Over time, repeatedly buying very low probability options may lead to more losses than wins. Options don't move in exactly the same way as stocks and ETFs. Trading options requires understanding how factors like time decay, volatility, and probability affect prices. Avoid these common mistakes, and you can improve your odds. Explore more about trading options in the following video playlist. Thanks for watching, and happy trading!